Good morning. Thank you for attending. It's a pleasure to be here at EnerCom. Nice to see a few familiar faces in the crowd. Thanks for the introduction. I am with Obsidian, and it looks like I don't need my glasses with this presentation up here, so that's great. I will be speaking to some forward-looking information, so the usual cautionary language around that, as you can see on this slide, as well as in our endnotes. And the presentation when you have a chance to look at that in greater detail. So as mentioned, Obsidian is a mid-sized Canadian company. Our production base is well established. We do have a low decline rate. It is an oil-weighted asset base. So with that low decline rate generates very strong cash flow for us. The Williston Green and Pemina assets are in the Cardium formation. That is the bulk of our production. We have high growth assets in the Peace River area, which I'll talk about more in a moment. That's a heavy oil play. These assets generate strong free cash flow. We have been reducing our leverage as well as some return of capital to shareholders. We bought back 2.2 million shares for a little over $18 million, and we are committed to strong ESG practices. Just to orientate you where our operations are, the map of Alberta on the right-hand side of this slide. Again, the Cardium position, which is a little over 22,700 BOEs a day of light oil in central Alberta. That is the backbone of the company. We do have a nice little asset in the Viking play in southeast Alberta. It's about 2,100 BOEs a day of production, again, light oil, and generates free cash flow for the company. And then the growth asset for the company is in the Peace River play up in northern Alberta, which is a heavy oil asset. Just looking at some of our statistics, our guidance, midpoint of our guidance is about 32,000 BOEs a day. That'll be about 4% growth production year over year, and I'll talk about our revised guidance in a moment. We are about 2/3 oil and liquids, most of that being light oil. A very strong reserve base at 181 million BOEs of 2P reserves, giving us a reserve life index of 13 years and a very modest decline rate of 24%, which helps us generate that free cash flow. And importantly, we have a strong tax pool base of $2.4 billion, which will help shelter that free cash flow. Our estimate is at $75 WTI, that probably gives us 10 years of shelter. Just some of the things that we are focused on in terms of objectives for the company. We're looking at driving per share growth in the company via asset development as well as further debt reduction. We are going to use the free cash flow that we generate from our Cardium and Viking assets to grow that Peace River asset. We are looking to increase the size and scale of the company. We do look at M&A opportunities, but we'll only do it if it certainly makes sense for our business. Our target net debt is $225 million. How do we get to that number? At this size of production base, that equates to about 1x debt to cash flow at $50 WTI. So that's how we triangulate on that. And we are committed to providing a return of capital, which we've already demonstrated with some share repurchases. In 2023, we have a capital program of about $260 million. $25 million of that is really focused on exploration and appraisal work up in Peace River. It's an area that we have re-entered to recently after we bought out our partner there, and I'll get into that in a little more detail. In the Peace River area in the first half of the year, we did establish a new development field called Walrus, and we've also been drilling some exploratory coring holes, which are called OSE wells, both for the Blue Sky and Clearwater formations in that area. We did have some fire impacts, which I'll talk to in a moment. I'm sure you heard about the wildfires in Alberta. And our second half program will be focused on Peace River, Williston Green, and the Pemina area of the Cardium. Financially, we're looking to generate free cash flow of about $65 million. We'll continue to reduce our debt and leverage levels. We have some high yield notes outstanding. We did a $127 million issue, Canadian issue back in July of last year, and we've repurchased some of those on the open market. We've also expanded our bank debt facility from $175 million to $240 million this year, which gives us ample room. And we believe at this size of company, again, that RBL facility is probably about where we want it to be, so we're not subject to any borrowing-based redeterminations. As I mentioned, we are committed to a return to capital program. So just, we came out with some updated guidance earlier this month with our second quarter results. On this slide, you can see our 2022 actual results, what our original guidance was, and then our revised guidance. We have brought production down slightly. The wildfire impact was about 2,100 BOEs a day in the quarter, or about 525 BOEs a day for the full year. There was no major damage to any of our operations, but we did have to shut in production due to the fires, and so that's the impact from that. We also have a debottlenecking project where we're lowering line pressures in our Williston Green area, and as a result of that being mostly gas, and given where gas prices were in Canada in the summer, we decided to defer that project so that the gas would come on with the winter season in November, so that had a slight impact to the production as well. We have solid operating costs and G&A costs. I think for a light oil producer, that will put us in good standing with our peers. With this guidance, we did lower our price forecast to $75. That's for the August to December period. We did also improve the WCS differential because that heavy oil prices have improved in Canada. And so with that, we expect to generate $350 million of free cash flow, $350 million of funds flow from operations, generating $65 million of free cash flow, leaving us with net debt at $290 million at the end of the year. If you're looking at the jump between our original guidance net debt of $215 to the $290, the reason that jumps as it does is because of a couple of things. One, obviously the lower commodity prices and lower production. The second thing being that we have spent about $18 million repurchasing shares, which wasn't in the original guidance. And then the third thing being that we rejigged our capital program so that there's more capital coming in Q4, and there's a little bit of a working capital build into the end of the year there. So all in all, still with that debt level, we're running at less than 1 times debt to cash flow. And you can see on the bottom of the slide some sensitivities to various prices. In terms of Q2, we had a solid quarter. The 31,000 BOEs a day, again, was impacted by the 2,100 BOEs a day of production we had shut in for fires. So without that, we would have been right on top of it, of where we were in Q1. Our operating costs were up slightly. That's because of the lower production level, again, due to the fires. Nonetheless, we did still produce a very strong netback and funds flow from operations that was largely the same as Q1. So all in all, a pretty solid quarter given those impacts that occurred earlier in the quarter. So looking at our 2023 development program, again, we're concentrated in 3 areas. Williston Green and Pemina is what we refer to as a Cardium here, the Peace River asset and the Viking asset. We're drilling 46 wells this year. Originally, we're looking to drill 49. We did scale back a little bit, given that we pulled our our WTI price down. And we haven't seen service costs come down as much as we would have expected given where prices have come down. So we decided to defer some wells into 2024. Having said that, we're still drilling 46 wells. 25 of those were done in the first half of the year, plus those 4 exploratory wells for coring, taking us to 29, and then we'll drill 17 wells here in the second half, largely split between the Cardium and Peace River. Looking at Peace River itself, This is an asset that the company's had for a long time. It was originally part of a joint venture with our partner having 45% working interest. They had a multi-development program starting in 2010. There was really nothing done on this asset. I joined the company in December 2019, and for several years before that, up until just recently, there wasn't much done. So we bought out our partner's 45% interest for about $40 million at the end of 2021. So a very good deal for the company, probably picking up upwards at that time about 180, 90 net sections of land out of the total 500 that we own now. Excuse me, just need a little water here. The production from this asset is primarily blue sky. It is the deeper formation compared to the Clearwater, which lies above it. Having said that, they're not very deep. We're talking about 650 odd meters deep for the blue sky and 450 meters for the Clearwater. It is cold flow, heavy oil production. We have extensive infrastructure in the area from other investments prior to when there was the joint venture partnership. So we have a 50% ownership in a gas plant with Baytex, as well as 100% ownership in another gas plant. So we have about 70% of the gas processing capability in this area, which is important. This is in the oil sands region. And as a result, you have to conserve the gas. So while there's not a lot of gas with this production, whatever you do have, you do ultimately need to conserve. So we think that's a relative strength for us compared to our competitors in this area. Also, you need road infrastructure, which we have a fair extensive amount. And so we feel relatively advantaged as we look at this play. And overall, out of the 500 sections, currently we're only producing out of about 34. So there's a lot of running room left. I'm not suggesting that all 500 sections are going to be prospective, but there's certainly going to be a lot more than 34. Within the Peace River, we look at two things, blue sky and Clearwater. When we look at the blue sky, again, it's a traditional cold flow heavy oil that we've been developing over a number of years. In the first half, quite exciting, we've got this walrus field that is a new development area for us. If you look at the pull-out of the map, you can see a northern part and a southern part. We drilled one well in each. Both were productive and successful. The northern part is winter access only, so meaning you can only get in there after freeze up. The southern part is all year round access. The wells have come on very well. We'll be back in here drilling down in Walrus a little later in the year. We have started our second half program in Peace River with one well at Cadott and then Harmon Valley South and then Walrus. So more to come on this field. Clearwater potential. What I'm showing you here is a regional map of the Clearwater. If you look down in the southeast corner where it says Martin Hills, that has been the traditional Clearwater development play that you've heard about from companies like Spur, Spur and Delta Stream that was recently bought by Headwaters. So a very prolific play. I'm sure a lot of you have heard about it. Well, that trend has started to go towards the northwest. And you can see on the western side of that map where our acreage is. We're in yellow. Our competitors are also listed there. But you can see that we have a fairly dominant position. But I will caution you, it is relatively early days for the Clearwater in this part of the fairway. But there's a number of industry participants that have been drilling and bringing on production around here, and we have been doing the same. We will be drilling 3 wells here in the area called Dawson, which is kind of at the southern part of our acreage, specifically for Clearwater, so quite excited about that. And as our team has been working through this, we will be coming out with a Clearwater development plan, a Peace River development plan for both Blue Sky and Clearwater in September, so stay tuned for that. Many of you might know the Cardium is a very historical play in Western Canada, in Alberta. It's been producing since the 50s. We are the largest actually landholder and producer within the Cardium itself. It's gone through many phases of development. So obviously right now it is in the using horizontal wells with multi-stage fracs, as everybody is doing. So it's added new life to this play. We're in two areas. The blue area on top is Pemina, and then the Williston Green area is in the green and purple below. So just focusing on Williston Green, this is a relatively newer production for us in this area, been quite prolific. This is where the debottlenecking project is going on, where we're lowering line pressures, being able to add additional production reserves, as well as facilitate future development. So very excited about what's going on here. We'll be drilling 7 wells in the second half here, following up on the 5 wells that we drilled earlier. Pemina is a traditional Cardium field. It's water flood supported, so it has very low decline production. We will be drilling a couple of wells here in the second half of the year, following up what we did earlier. Lots of inventory and infrastructure in place here, so it's the gift that can keep on giving. Our Viking asset that I pointed out in southeast Alberta, something that we hadn't paid a lot of attention to while gas and oil prices were low. We came back there in 2022 and drilled 8 wells, including 1 step-out well on the west side that you can see the star on the acreage. We followed that up this year with 11 additional wells. Very pleased with that program. It's opened up a new area for us, so this is an asset that we can continue to grow and develop over the years. And so a great little economic project and free cash flow generator. On the ESG front, as I mentioned, we are committed to strong ESG practices. On the environmental side, you can see on the left-hand side the reduction in GHG emissions over that time frame, 40%. Same with injected fresh water use. And we've had a very strong program to reduce inspect our pipelines to reduce failures, which has been quite effective. So that's resulted in a 75% reduction in failures. Safety is a very important part of our corporate culture. Worker initiatives are things like safety meetings, inspections, investigations, etc. Just in 2021, we did over 10,000 of those, so you can imagine that's a lot of safety meetings going on. Strong female employee base and a very strong economic contributor to Western Canada, obviously. On the governance side, 86% of our board is independent. We do have decent inside ownership at 7%, and our compensation is aligned with shareholders. When the shares go up, then we do better. In terms of asset retirement obligations, given the history of the company and some of the legacy, we do have probably relatively higher ARO compared to other companies. It's something that we're very good at managing, which we've done over the years, and have steadily brought that number down over time. We've used government programs such as the ASRP, the Alberta Site Rehabilitation Program, for funding to help reduce this. Something that we'll continue to manage going forward. It would take typically anywhere from 20 to 25 million of our cash flow on a go-forward basis, so somewhere in the order of 3-4%. Tax pools, as I mentioned, which would be a big offset to that ARO liability. We do have 2.4 billion of tax pools. 1.9 billion of that is immediately deductible, meaning that if we had all that income, we could utilize them right away. Just to give you an idea what that potentially could be worth, we took a schedule of saying if we use 200, 300, 400, or 500 million per year, what's the value of that? We discounted it at 8% because it's a known value, it's not a risky value. And that translates anywhere from $4 to over $5 a share. So quite a lot of embedded value for tax pools, which I don't think we're getting recognition for. On the hedging side, we do hedge. We view it as a tool to help preserve cash flow. We're not a mechanistic hedger, we're more a opportunistic hedger. So given the backwardation in the oil market, we've tended to do things on a shorter term basis. I will say we do have the ability to fluctuate our capital program quite considerably, and we've done that in the past, so that also helps with us not having to go out and hedge at prices that we don't think are attractive. We picked some WCS or heavy oil differentials up with a couple of hedges. We've also hedged on the gas side because we were pretty bearish about where we thought summer gas prices would be, as well as winter. So in fact, we had about 75% of our production hedged in the summer, which has turned out to be a good call. And recently, we've just added in some electricity contracts for the power side, for the operating cost side of our business. Fortunately, that market is backwardated, so as a buyer, we get to take advantage of that. And previously, we never used to hedge electricity because there was a pretty good correlation between gas prices and power prices in Alberta. That's really fallen apart, so that's why we've decided to hedge some electricity contracts, and we'll probably do a little bit more of that. Just on the reserves that underpin the value of the company, we're showing you our last year's reserve report at various flat prices, $65, $75, and $85. Our share price, you can see there when we did this slide, was $9.43. And then if you look at the stack bars on the side, you can see on a PDP basis or approved reserve basis, that's essentially at our share price or higher, depending on what price deck you want to pick. And then, of course, as you add 1P or 2P reserves, that number goes up. So, you know, you're looking at anywhere from $10 to $30 in value, depending on how you want to look at reserves. I'd say our reserve book is fairly conservative. We've enjoyed positive technical revisions over many years. We also have a reasonable FDC, or future development cost, built into our 2P reserve. Is only $250 million a year. So in conclusion, I think we have a pretty compelling story for you. Peace River is our growth asset. We'll be coming out with that plan in September to give you more of a delineation on that. Our Cardium land position is very solid and strong, generates exceptional free cash flow for the company that we can use elsewhere. We will grow that asset modestly over the years. We do have low decline production, which generates free cash flow for us. It'll help us achieve our debt target, as well as do a balance of a share buyback as well. We have the tax pools that I talked about. We're really focused on operational excellence, and as well as being good environmental stewards with a good corporate governance policy. So with that, that concludes my remarks, and I think I pass it back. Thank you.